In 2021, the Federal Reserve told us inflation was transitory. It would pass. By 2022, it was at a 40-year high. They told us the rate hike cycle would bring it back to 2% swiftly. It didn't. Now, years later, core inflation remains above target, and the Fed is still navigating it. This isn't just an embarrassing forecasting record. It's a window into something more important. Why inflation is so much harder to kill than models predict. Today, I want to look at the structural reasons for that, and what the historical record of inflation cycles tells us about where we're likely to go from here. The initial post-pandemic inflation spike was largely driven by goods, supply chains, semiconductors, shipping costs. That component did come down. But services inflation, wages, rents, healthcare, insurance, has proven far more persistent. Services inflation is driven by labor costs, and labor costs are sticky. Once wages go up, they rarely come down. This is the component that has kept core inflation elevated long after the headline numbers started declining. The way the CPI measures housing costs uses a concept called owner's equivalent rent, and it has a significant lag relative to actual market rents. Real-world rental costs peaked and began declining before the CPI shelter component caught up. This created an illusion that shelter inflation was still rising when real market conditions had already turned. Now the reverse is true. Shelter costs in the CPI may continue moderating even as real rents in some markets begin rising again. The Federal Reserve raises interest rates to cool demand. But simultaneously, the federal government has continued running large deficits, injecting stimulus into the economy through spending. When fiscal and monetary policy work against each other, monetary policy has to work harder and longer to achieve the same result. This is the structural constraint the Fed has been operating under throughout this cycle. The historical parallel that concerns me most, and that I think deserves serious attention, is the 1970s inflation cycle. What most people don't remember is that the 1970s had two waves of inflation, not one. The first wave peaked in 1974. It came down, people thought it was over. The Fed eased prematurely, and the second wave, which peaked in 1980 at over 14%, was worse than the first. The premature easing was the mistake. And if you look at the current cycle, the Fed raised rates aggressively, inflation came down from its peak, and there has been significant pressure on the Fed to begin cutting. Some cuts have already happened. The question the 1970s forces us to ask is, are we at the same point in the cycle? Is the inflation problem genuinely solved, or has it been suppressed without being eliminated? I want to be precise here. I am not predicting a second inflation wave. The structural differences between now and the 1970s are real and significant, but the possibility deserves to be on your analytical radar, because if it materializes, the consequences for bond markets, equity valuations, and purchasing power would be severe. Awareness is not alarmism, it's preparation. The three indicators I'm watching to determine which scenario is unfolding: core PCE inflation, the Fed's preferred measure, wage growth relative to productivity, and the 5-year break-even inflation rate in the bond market. When sophisticated bond traders start pricing in higher long-term inflation, that's a signal worth taking seriously. I'll cover all three in depth in a future video. Next week, the commercial real estate crisis, why it's bigger than most people realize, and which banks are most exposed. Subscribe so you don't miss it. And if you're a trader trying to navigate these macro forces, capital collapse in the description. See you next week.